laptop crashed this morning, so it's been a fun Monday morning.
Like crash?
Oh, that's
Yeah.
it. It's just like it's the Monday morning gremlin, you know?
Yep. I should have known. It gave me the blue screen of death on Saturday in the middle of an application, and then it loaded back up, and that was it.
What do you have?
Dell.
Who's that?
Oh, well,
Give it to me.
Hey, Heather.
Yes.
I'm gonna just, since it's just kind of your group going, you know, that we're doing this with, we'll just keep it open for questions and stuff. Do you wanna, I mean, are you able to take, you know, I'll answer the questions, but I mean, if you can, there's somebody like wanting to ask a question or something, are you able to see that on your end?
Yeah, we're all here in person.
You are there in person?
Yeah, we're all here in a conference room.
Okay. So yeah, we just, you know, as this is you guys' time, so as we go through it, if there's any questions, just let me know. I'll you know, just stop and kind of go over stuff. Does that
Okay,
work?
perfect. Yep, let me go round everyone up.
Okay. Well, yeah, I'm ready to go whenever you are. Just let me know when, okay?
Okay, thank you. Migrate. Oh, your boots are so cute.
They're comfy. And I was gonna wear like heels and I forgot we're going to a rural property. I was like, that probably would be smart.
Yeah, right. This chair? Oh. Oh, sure.
Oh, yum. Burritos.
Thank you.
Yeah, thank you. Hi, Lee.
Hello, how are you?
Good, how are you? Come on, that's someone. You can sit here.
Swookie was at the house, so I'm just not able to guy.
Okay, Colby, we're here, and then we have two that joined as well that couldn't be here in person.
Okay, no problem at all. And let's see. So everybody can hear me okay? Everybody can see the screen okay?
Yep.
Perfect. Okay. Well, everybody, thank you for attending on a Monday morning. I know you all are busy, so I will keep this as brief and sweet as I can. My name is Colby Popplewell. I'm with Finance of America Commercial. I'm a field market specialist, so I work directly with customers. I work with loan officers. I work with agents. You know, on the commercial side, it's kind of got a wide open ability, meaning I don't have to be licensed. There's a lot of things I'm able to do and help with, and I'm not usually held back by any kind of red tape that you might see on like a forward mortgage or anything like that. But jump into our name real quick, Finance of America Commercial. Real briefly, the name commercial is a little misleading as we don't do any kind of commercial properties, with the exception of maybe a mixed use. Everything we do is going to be residential. That's anything from 1 to 4 unit, and we also do 5 to 20 unit. Different set of guidelines, but we will do up to 20 units. In case any of you have investors that like to work with people who are doing larger properties, more units, etc. Okay. All right, so real quick, even with our shutdown last year for a little while, we've done over $4.2 billion in investor loans. We have that's over 15,000 units that we've done. We have more than 5,700 approved investor borrowers. And like I was saying earlier, is even with that many approved investor borrowers, I still come across people every single day who just they don't believe that this program exists. Sometimes I got to talk people into going looking at stuff that we have. Sometimes it's too good to be true, right? Because they're used to seeing hard money lenders, you know, the higher cost, and then they're used to banks who are going to be a lot harder to get approved with. We fit right in the middle. We have, you know, really good pricing, and we make it pretty easy for investors to get approved with us and, you know, start using us for their investment needs. We are, not that it really pertains to this group, but we are a nationwide lender, and there's only a couple states that we don't lend in, and that might just be because there's really not a lot of business. I mean, the Dakotas, and I think it's New Hampshire. I think those are the only 3 states that we don't lend in, so. So, why investor loans? Well, diversify and expand your business with a profitable niche. This is gonna give your investors some leverage, right? That's gonna be able to get them to use our money a little bit less, you know, at a cost, but not very much. But it's going to give them the ability to do maybe fix and flip, or construction, or bridge loans. If you have people who are investors who like to get rental properties, we have that. Our typical investors are funding 4 to 8 deals a year. And, you know, if we're talking about fix and flip, we're looking at, you know, for agents, we're looking at, that's 4 to 8 purchases that you might have, plus turning around and being the sales agent on that and being able to sell those as well. So it's really a win-win for everybody involved. Excuse me. It's just, you know, sometimes there's inventory issues, sometimes there's, you know, little things here and there that might be a little hiccup. But other than that, you know, we have our investors who like to use us over and over again. This can create, like I said before, this can create a recurring income for everybody involved, whether it's an agent, whether it's a loan officer. The more deals that these investors are able to do, the better off, you know, we all are, actually. It's kind of recession-proof in that you know, if we come up across a situation where we might be coming up where, you know, people might have to sell their homes, people might have to, you know, get rid of property, they might have to, you know, find another means of where they're gonna live. Our investors, I mean, they say it like this, but they can kind of take advantage of that and be able to come in, buy those up with, you know, using the Finance of America commercial programs, and keep the circle going, right? You know, these people are selling houses that they got to sell them at a discounted price. Our investors can get a good price on this, do a little fix up, or keep them as rentals, and keep that going. Something new to us, I shouldn't say new. When we came back from COVID, because we shut down for COVID, once we came back, we had some really tight guidelines, you know, compared to what they were before. And now, one of the guidelines was they had to have a certain amount of experience in order to use our programs. We've completely opened that up. You can have people with no experience, all the way up to people who have, that this is all they do. We work with everybody, both spectrums and everything in between. So, as I mentioned, we're doing short-term loans, 12 to 18 months. That's going to be fix and flip, bridge, new construction. I'll go into those in a moment, kind of what the quick guidelines are, what they are, et cetera. And then we have our long-term loans, which are going to be your rental properties and your portfolio loans. We are very competitive with our interest rates, our loan to values, and our LTCs. LTC is going to basically, it means loan to cost. It's basically going to be, excuse me, the purchase price plus the rehab. So when you hear LTC, it's going to be purchase price plus rehab. That's the combined number. Business purpose, these are business purpose loans with no income verification. So there's no income, no employment verification, no W-2s, no tax returns on any of our programs. As I mentioned before, we're not lending in North or South Dakota or Vermont. The property types we're doing are going to be single family, 2 to 4 unit, condo, multifamily, and mixed use. Now the mixed use, just a little caveat to that, mixed use will only fall into the fix and flip and bridge program. We don't have a long-term loan for that. As mentioned before, no investing experience. All our underwriting is risk-based, and that's what determines the interest rate and loan size. I'll go into that in a minute as well. The terms are determined by the borrower's credit score and experience. So I'll be talking about an exposure limit, and the way that we determine all that information is going to be basically their experience and their credit scores. Any questions so far?
No, it's great.
I don't believe any of this is true. Just kidding, this is awesome, thank you.
Welcome to 25% of the country.
Right.
I get that all the time. I get people who are like, okay, what's the catch? What's the catch? Well, there's really not a catch other than, you just gotta meet the minimum requirements, right? These properties pretty much carry themselves as far as, risk, and, that's how we price it out accordingly. So, what are fixed and flip loans? Now, this might be kind of redundant, it might be just telling you guys something you've already heard. I just go through it just to be, don't wanna make too many assumptions, make sure everybody's on the same page. Basically, short-term business purpose loans used for real estate investors to finance the purchase and rehab, of properties and sell for profit or refinance and hold. Improvements range from just minor rehab to very extensive rehab, okay? And it says purchases, but just to let you guys know, I know you guys are more on the purchase side, but we do, refinance as well. So if you have an investor client who's got a couple properties, they've been hanging on to them, whether it's a rental or it's something they're gonna end up getting rid of, we will do it as a refinance, no problem at all. Still give them the rehab money, give them a 12, 18-month interest-only loan, let them do what they need to do. They put this work into it, they end up saving it, maybe they make an extra $200-300 a month on rent for all the work that they're doing. May not recoup right away, but it might be a long-term investment that they can recoup down the road. So with fix and flip, I'm just gonna kind of go down this information. We've got 2 pages of it. It's pretty basic information. I'll stop and after things that I think you might have questions on, and then I'll just open it up to questions once I get through these matrices. So again, no experience needed. We can have somebody come in who I want to get into investing, and they just don't have any experience. Now, it's not gonna be priced the same as somebody who's done 25 properties in the last 3 years, right? So it's, you gotta, when I speak with them, I gotta meet their, kind of set their expectations a little bit that, their rate isn't gonna be 4.5%. Sometimes that's kind of the hurdle sometimes as they see interest rates on a forward mortgage, rates are 3 or 4%. They consider our rates high, which for a short-term, high-risk loan, our rates are actually pretty low when you compare it to a hard money type deal. Our look back on these, this is gonna be a 36-month look back. And that refers more to the exposure limit I was telling you about earlier. So when we determine, they don't have to have experience, but the more experience they have, the better their terms are gonna be. So what we're looking for is any kind of transactions that are investment that they've done in the past 3 years. There's gonna be 2 categories. Category number 1 is gonna be the sales that they've done. So if you have a flipper who's done, say, 7 properties in the last 3 years, we're gonna count those 7 properties. If you have, let's say the same person has 5 rental properties that they bought in the last 3 years, we're gonna count those as well. And what we're gonna do with those sales is we're gonna count the sales prices, and then on the ones that they've held, we're gonna count the purchase prices. So when you add all this up, they've got 12 for experience, okay? That's the number that they have for experience. Then we're gonna add up the sales plus the purchase prices, and that's gonna be their exposure limit, right? What that exposure limit means is Finance of America is basically telling the customer, we're gonna lend to you this much money at any given time. Whether that's 1 loan, whether that's 7 loans, whatever it is, that's what we're gonna lend to you. And even people without experience who don't have that, we're still gonna give them a $500,000 exposure limit. They're still gonna be able to play with $500,000, get a property or 2, keep it moving. Okay?
Hey, Colby. Colby.
Sorry about that. Minimum credit score is 620. Believe it or not, our minimum credit score is 620 on these. Unlike a forward mortgage, who will take the middle scores of the people who are getting the loan, and take the lowest of those scores. We're gonna do the exact same thing, except for we're going to use the highest middle score. Okay, so you have, in a Ford mortgage, you have somebody who has a 636, and you have somebody who has a 784. They're gonna use the 636. We're gonna use the 784, okay? And that will come into play when it comes time to getting their terms,
Hey, Colby?
okay?
Colby?
And then yes, I'm here.
Okay, real quick, is there any way, since my computer crashed after this, can you email Christina Salcido the PDFs to these, please?
Yes.
Because we're all watching one computer screen, and so it's a little hard to see.
So what I'll do is I'll send it to you, and then I'll let you disperse it. Does that sound, is that okay?
Yeah, but I don't have a
Oh,
computer right
wait,
now.
I'm sorry, you said your computer crashed. I'm sorry, you just explained that your computer crashed. Yeah, let's talk after, and then
Okay.
you just let me know where they need to go, and I'll get it done.
Thank you.
Yep, no problem.
Okay, go ahead.
Loan size is 50,000. What's that?
You're good?
You have a question?
No, we're good.
Okay, so individual loan size is 50,000, okay, and that's all in, that's the purchase price plus the rehab, and then whatever LTV they get, it's gonna be that amount, minimum 50,000, up to 3 million. As I mentioned, the exposure limit, minimum is 500,000, and we'll go up to 10 million. For maximum loan to value, now, when it says maximum loan to value ARV, that's gonna be the after repair value. That's gonna be after they've done all the rehab and everything, they're gonna get, we're going to get, an appraisal, and it's gonna have two values on it. It's gonna have an as-is value, okay, and that's for when they purchase the property, and then they're gonna have an ARV. And they're gonna get comps for both sets, right? So, we give them a budget, we give the appraiser a budget, that the customer fills out. It's gonna have all the work they're gonna do to the property. The appraiser is gonna go out and base the value off of all the work that's going to be completed. Our max on that is gonna be 75%, okay? Now, our standard, the max purchase loan, or the LPC, it says up to 95%. I would say that's misleading, but I have had a couple that have gotten close. There's a calculation that that we do that it's not the easiest to get to. I'd say going with a 90% standard rehab on the LTC is a little more likely, and that's going to be for your more experienced people. The people who don't have the experience, 0 to 2, and then that's what I'm talking about with low experience. They're going to be capped at 85%. Okay, we have what's called extensive rehab. Those are going to be a little bit less on the numbers as far as the LTC and the ARV. Extensive rehab is basically anything that has major work being done. It's a 3-unit being changed to a 1, vice versa. It's going to be where the rehab is going to be greater than 50% of the total loan amount. That's an automatic extensive rehab. They're going to get a little bit lesser terms on those. But still, with as much work and everything that's being done, it's still a pretty good deal. Multifamily, I'll just go over that real quick. I don't know if we are going to be doing any 5 to 20 units. But on standard rehab, it's going to be reduced to 80% LTC, and if it's extensive rehab, 75% LTC. And then we work this now. This is where it kind of gets more interesting versus pre-COVID. What we were doing pre-COVID is we were just capping everything at like 90%. Whether it was the purchase plus the rehab, we were doing it 90%. Got a little tricky with the calculations. So what we're doing now is we're taking that LTC, and let's just say that's at 90%. So the borrower's got to come in with 10% of the project costs. That project cost is the LTC, which I think earlier is the purchase price plus the rehab. So the borrower's going to come in with 10% of that, let's say. That money is going to go towards the purchase, right? So now they've got all that equity, that extra equity, into the purchase of the property. We're going to put 100% of the rehab budget into an escrow account, and that's what they're going to draw from. So now with the new guideline, they can always expect to get 100% of those funds that they can draw from. Okay? Borrower type, individuals and entities. So we'll do corporations, LLCs, husband and wife, just with their names, pretty much however they want to do it. We can't do trusts, we can't do nonprofits, Although I have a nonprofit that got approved, it was grandfathered in, but we don't do those anymore. Eligible properties, again, went over that. Everything's got to be non-owner. That's the one thing we gotta remember is everything that I do on my side is a non-owner. And that's all of our programs. That's going to be, again, single family, 2 to 4 unit, condo, multifamily, mixed use. We're going to finance hard costs and soft costs. Pre-COVID, it was all hard costs. And what we've added now is they can actually finance just about every cost they have that's a third party. They can't finance the Finance of America costs, but anything as far as title, insurance, permits, anything like that, they can now finance, and they can actually get that money back after they close on their first draw. Loan terms, so we're looking at a 12-month standard with an 18-month option. Right now, our fix and flip and bridge are not pricing any different, so I put everything on an 18-month. So they technically can have these properties for 18 months, interest only, and not have to worry about it. If they finish 3 or 4 months into the program, they still got that extra time to do whatever it is they need to do with it. Our rates are fixed, so once we close, it is not an adjustable. So if they close at 9%, it's going to be 9% all the way through that loan, and it's going to be, again, interest only. We do not have any prepayment penalties. Everything that we do is, well, not everything, I'm sorry, this program is a 90-day interest on the maximum amount. Basically what that means is if they let's just say that they rehab it quickly, they find a buyer, let's say it's a cash buyer, and they're at 75 days in on their HUD. When they sell it, they're going to see an extra 15 days of interest, because it's got to equal at least that 90 days. Interest accrual, see, interest is only charged on the actual drawn balance. Now, that's going to be for our customers who have 3 or more of the experience that I spoke about earlier. They will, they'll be able to pay interest on the drawn balance. And what that means is when they buy the property, and let's just say they put $50,000 into the escrow account, they're not paying any interest on that $50,000 until they actually draw it. So let's say when they buy it, their loan amount is $100,000, and 6 weeks down, they take their first draw for $10,000. Well, they're only paying on the $100,000 for that full 6 weeks. And then, let's say that's $10,000, another $110, they're paying that interest on the $110 moving forward. And it's on a daily basis, okay? Ineligible projects, I mean, it's, you can go down any kind of tear downs or ADUs, anything added greater than 500 square feet, no new construction. Now again, I'm just specifically talking about fix and flip. I do have new construction, it just doesn't fall into this category. Valuation requirements, the appraisal, spoke to you on that. Keep in mind there's no rural properties. And unfortunately the hard thing is the appraisers who determines if it's non-rural or not. I've had some properties that I thought were going to be rural, and ended up not being, and then vice versa. Sometimes there's some work that we can do to get that fixed. It's really it really is again determined by the appraiser. What is it, Los Lunas down in New Mexico down there?
Yeah.
I had 3 appraisals done. 2 came back non-rural, 1 came back rural. All kind of, I think, on the same street or within the same block. We got that fixed. It wasn't that big of a deal, but some of these towns or cities can go either way sometimes. And sometimes I get borrowers who have a conversation with the appraiser and say, hey, look, I'm sure that this could go, this direction, right? And appraisers a bit close or on the fence, could go either way. So it's typically not too much of a problem. Liquidity for our borrowers. So now, the way that we did it before COVID is they used to have at least $50,000 liquidity to get the exposure limit. Well, we removed that. They don't need a $50,000, they don't need any kind of liquidity to get the exposure limit anymore. The liquidity is going to come in on a per property basis, so it's at the property level now. They need to have in their account, it could be their personal, it could be business account, it could even be a business account that we didn't approve, as long as they are, on the operating agreement, they're part of that company and they can use the funds, we're okay to use those funds. But it consists of the down payment plus closing costs, 10% of the budget, whatever their budget is. And, it says any equity shortage, so if they're low on their, they're a little bit upside down on their equity, they gotta make sure they can cover that. Plus any required reserves. So somebody who doesn't have experience, 0 to 2, needs 12 months of required reserves. Somebody who has, 3 or 4 needs 6 months. And then anybody with 5 or greater needs, 3 months reserves. Okay? We do have an interest reserve option. Basically what this means is if your borrower wants to put money into an escrow account that we'll draw the payments from, for either 6 or 12 months, that'll, come out on the, whatever date it is that it'll come out on. A 6-month, cash flow on that will be, a reduced rate by half. And if they decide to put 12 months in there, we'll reduce their rate by 12. Don't have that happen very often. My customers typically flip these properties pretty quick. So the benefit in, interest rate reduction is not, it doesn't work for them because they can use that cash to go towards another property, right? So it doesn't always make sense. I do have a couple that did it, but it's not very common.
Colby, I have a question.
Any questions, I'll fix and flip. Yeah.
Okay, so liquidity requirement and interest reserves, is it one or the other? Like, so for example, if I put down 12 months of the interest reserves, can I offset the liquidity requirement?
Yeah, so it'll come from that. So let's just say, for example, you have a new borrower, and we have to verify 12 months of liquidity, okay? Well, if they put that 12-month liquidity in there, that covers it. They can put 6 months, they can put 0. Basically, as long as we can verify that in their account, let's just make it easy. Let's just say that liquidity requirement is $12,000. Okay. Well, they can put 12,000 in there. That still covers it. We've already verified that they have 12, but if they want to put 6 in there and reduce their rate by half, that covers it. Or if they want to put 0, as long as we know that they've got that 12 grand, cover it. They can do 0, 6, or 12.
So okay,
As far as the interest reserve.
I work best in scenarios. That's still a little confusing to me. So if prime example, I'm looking to purchase a property at $100,000. I need $100,000 for the rehab. What would I need in order to get that loan?
Without knowing anything about your background, because that's gonna.
We've had one deal in the last 3 months or 3 years.
Okay. And let's just say you're at the, you've done 4 properties. Okay, just to make this.
Well, what if we just did one? We've done one in the last 36 months.
So we got 200,000, right?
Yep.
At 15%, so you have to put 15% down. So you're looking at 30,000. So you'll need to come in with 30,000. Okay, that 30,000 is going to go towards the purchase of the property. 100,000 is going to go into the escrow account. So the down payment, we got 30,000 plus closing costs, whatever those closing costs are, points, third-party fees, etc. 10% of the holdback. So you have 100,000, so it could be another 10,000. So now you're in it for 40. Let's just say there's no equity shortage. And then reserves, whatever that interest rate is, it's going to be, whatever the interest rate, whatever that payment is for 12 months, we'll need to verify those required reserves.
Okay.
Let's just say, make it easy, let's just say it's 10%. Okay, so we got 170 divided by 12, multiplied by 10%. Oops, did it come out right? Sorry. 170 divided by 12. There it is, okay, times 12. another 17,000. So you got 30,000 down payment. And then what we have to show in the account on top of that, now, not that we're gonna take it, but we just gotta show, another 27,000, right? So,
So the only,
I'll break it down.
so basically like 30,000 plus closing costs need to be cash given out, and then 27,000 just needs to show that it exists somewhere?
Yeah, so that's gotta be in the account, or an account, it doesn't have to be the same account, it could be, you know, we can use multiple accounts. So it's gonna be 30,000 down, plus closing costs, I don't know what closing costs are, let's just say it's 5, so 35,000 down, okay? Plus 10,000 for the holdback, okay, that's the 10%. Plus the required reserves, which is 17,000.
Okay, so the 27.
Now, the 17,000 plus the 10,000 for the holdback, again, we're not taking that. We just gotta verify that it's in the account.
That's not bad.
Not bad at all.
Does that make sense?
Yes, that makes perfect sense.
Alright, any other questions?
How long do the loans typically take?
Oh, they said 18 up to 18 months.
No, how long do they take?
Process.
Oh,
Process.
I
Well,
don't
it's
know.
gonna depend. We have a desktop appraisal system now that we can get appraisal done in, 5 to 7 business days. That's gonna be for our more experienced customers. And then our appraisal standard, it just really depends on the area. It could take, a couple weeks. And that's really what we're waiting for. So, given those time frames, on a desktop one, I'm getting them done in about 14, 15 days total.
Okay.
On the standard appraisal, I'd say it's closer to probably 23 to 25 days. Now, one caveat to that is, we do, I do have customers who buy their property cash. I have a number of them going on right now, who buy their property cash so that they can get it, and then we refinance them to whatever their terms are. So if that's the 90%, we'll cash them out to that, that 90%. They'll get their money back on that transaction, plus we'll still put 100% of the funds into the escrow account for them to draw from.
Any other questions? So like if we
Okay,
we like to be conservative with our numbers. So like for example, the rehab we have right now, it may cost 75 or it may cost 100 to do the work. Would we just go for the full 200 loan instead of the 175? Like how does the extra money left on the table work? You're still just paying interest on it, right?
So once the loan is funded, we can't change it. So once that's done, you can't change. What I tell people is go a little high if you're not sure. We also build a 10% contingency into the budget. Okay, so that's partially covered. So there's never gonna be money left on the table. You'll either get that back at the end, or when you go to sell it or refinance it, that money's there kind of as credit,
Okay.
but it wasn't used.
Okay, that makes sense. So actually,
Does that answer your question?
so if we're thinking of 100,000 on the very high side, we should probably only do maybe like 90,000. So it'd be like 190,000 because you have the built-in 10% contingency, right?
If that's how you wanna do it. I tell people that, do your line items, do what, the retail cost would be on that, okay, whatever those line items are. Bump it up, a little bit, cause we're not gonna take any receipts or invoices or anything like that. It's just gonna be based off of the work complete.
Okay.
Right, so when the inspector comes out, excuse me, and you guys, and the borrower, the inspector comes out and says, you know what, the project's 30% complete. Well, the borrower's gonna get 30% of their money. It's not gonna be, I need receipts on this, I need, invoices on this. It doesn't work like that. It works just based off of completed work. And so, if if your line item you put on there is $5,000, but it really only costs you $3,500, we're still gonna give you the $5,000.
Got it. Okay. Thank you.
Okay. Yeah, no problem. Any other questions?
I just wanna make sure that I understood, so on 200,000, if you're a newer investor, you need about 57,000 down. Well,
Not down, verified.
or reserve,
30 down.
yeah,
You need about 57,000, verified, you're gonna come in approximately 35,000 of that.
Okay, cool. Okay, just wanted to make sure I understood.
Yeah, no problem at all. And here's the other thing too, guys, is I have a quote form that, we put all the numbers in for your investors. I put a term sheet together, initial term sheet, I send that to them, and all those numbers that we were just kind of going over is all broken down for them. It says, you're gonna be coming with this much, we're assuming that the fees are this much, and this is what we need to verify, and here's your rate, and it's broken down really nicely for the customer.
Colby, I'm gonna interject. It's
And
Heather.
I'll show you what that looks like.
You have to talk
Say that again?
this way.
I just want to tell them real quick, guys. So Colby will flip a quote literally in normal days within 2 to 3 hours max. So if you've got someone that you're interested in, you can get them over to me. I hand you the quote, which will take less than 2 minutes to complete. Send it to him, and he will send all the scenarios back fast.
Nice.
Okay, go ahead, Colby.
Yeah, I mean, I get it. I understand that these borrowers, they're competing for these properties, and the faster I can get them information, the better off everybody is, so that they can, make a decision, see if it works for them or not. And I try to be available weekends and evenings, because it doesn't take me a long time. I mean, I'm gonna be honest with you. I'm not gonna pretend like this takes me 30 minutes to put one of these together. It literally takes me about 90 seconds. So if I can get in front of a computer and I can just plug the numbers in and send it out on a Friday at 7:30 in the evening, that could be the difference between them getting the property or me getting them on Monday and losing the property over the weekend.
Yeah.
Right? Nobody wins if they lose the property. So that's how I look at it. So here's an example. So this one, the standard is going to be a 2-point origination. This borrower has a 9.5 interest rate. This particular loan amount is $820,000. They've got the drawn balance. Doesn't show their experience on here, but that means that they're at least at 3 or greater on their experience. It's a standard rehab. They would need to have $160,000 down, based on up here $180,000 for project costs plus the purchase price. They're going to need $160,000. Oops. They need $160,000 to come in on this property. Now, it says cash from borrower. Now, we're doing some estimates when we do this, right? We don't know exactly what the title is going to be, what the insurance is going to be. We're just kind of doing an average and giving them that. So this isn't set in stone. This red number over here, that's not set in stone. It's just an estimate. But the total liquidity that we have to show is going to be 160 plus that 95, and then plus the fees over here, right? So this fee is the total with down payment and everything. So what we would need to verify in their account is $313,300 for this particular loan. Okay, I know that's a lot of numbers thrown at you, and I do go over this with the customers.
Colby,
But I just wanted to show you what one of these.
can you pull up ours that you
what
did
these
for
look
us
like.
the other day?
Say that again?
Can you pull up ours that you did for us the other day? Because I just have a couple questions on it.
What's the bar's last name?
Salcido, Salcido. I think it is under me, right?
Yeah, and Colby, it's actually Kiki and Christina who's here. It's their personal quote.
Okay, can you spell the name again? It's hard for me to hear. What was the last name again?
Salcido, Salcido.
Yeah, okay.
Yeah, because that's us. I'm just curious to see.
Yep, so at a 110 purchase price, 100,000 for the projected project costs. Based on the information I had, the loan amount, the custom loan amount was $178,500. We're looking at a total of 10% interest rate. Origination on this one was 2.5. Now it could be because of experience, could be because of credit score, it could be a combination. It doesn't break it down. It just gives the numbers.
60 experience, not
It must be 0 to 2 on this one because it's got a full balance amount
Correct.
that they have to pay. Standard rehab, need to come in with 31.5 on this particular one. Cash from borrower total is just under 45.
Now, what
that
is
has, again,
what is that?
estimates on fees and everything.
what's
And
the
then the money that we would have to verify total is that number right there.
Okay, so I guess I'm super confused because when we were talking earlier, we were saying that all we needed to show was like when we were doing the example, 35,000 to close and 27 to show in the account. Why is it 72 now instead of the 57 that it was
It's just
before?
showing that you have that liquid.
I know,
So
but I
is
thought that
that
this was
that's
showing
included
the.
in
I
that?
thought the 27,850 was liquid, so I'm confused.
That 27,850 is after closing, so 31.5 is needed for the down payment, plus the 27,850 needs to show after we close, right, plus closing costs. So this number in red, plus this number here, is this number here.
He has just closing costs really high on that.
Okay. I'm still super confused. I'm
So-
So
sorry.
this number includes,
So this is what you're putting down?
this number
This
in
is what
red
they're
includes
asking
the
to
money
have
that you're
after,
coming down with,
that's
plus
including
closing
both of
costs.
these
But why? I
numbers.
thought
Right.
this was what we were putting down.
So I don't know exactly what closing costs are gonna be, that's just an estimate.
The closing costs are very
On top of
high
that,
there.
we need to verify after closing that there's gonna be 27,850 in the account.
So just, that's estimated. Down
That red
payment
number
closing
plus the
costs
number,
plus
the
that.
27,850,
Equal that.
Oh, so he's just doing super high
Yeah.
closing
Yes.
costs. Okay, so the closing cost is that the minimum equity required, the 31.5. Is that including your origination fee or no?
no, that's
So
just,
that's
that's
why
just
that's
the equity into the property, that's just the down payment.
Oh,
The red
okay, so it's
includes
that plus
that.
that is that.
Mm-hmm.
Okay, sorry, that was super confusing. Okay, got it.
No, that's why I do these, because it is a little confusing, it's a little different than normal, and, you know, that's no problem at all.
Okay, so overall, I would need to basically, I mean, this is an estimate, but I'd be looking at probably $40,000 to put down instead of the 31.5, and I'd have to show 27,850 that just exists in my account, in addition.
After closing, correct,
Okay, got it.
which is approximately this number here.
Perfect. Alrighty.
That work?
Yes, sir.
Alright, any other questions on fix and flip?
No?
Alright. Awesome. Alright, bridge loans. Now, our bridge loan has a little bit different definition, well, a lot different definition than a forward mortgage bridge loan. A forward mortgage bridge loan is, you know, take the equity out of one property, put it in another, and you got both of them kinda under one loan. Our version of a bridge is basically a fix and flip loan without the rehab money. And people ask, well, why would anybody get that type of loan? Well, few reasons. In any investment property that they have, whether it's a rental, whether it's something that they've, you know, they built and they're taking it off the market, let's say it was on the market for a month, they wanna take it off and just cash out, we can do that. If they wanna buy Airbnb is hard to find loans for, and if it's a property they really want, we'll give them a loan on it for, you know, 18 months, interest only, until they can go and find the financing. So there's a number of reasons that they can use a bridge loan for. It either needs little or no rehab, and it's basically an investment property that they're gonna get for 18 months at a, you know, whatever interest rate they qualify for. And it's still under the same exposure limit. So with the exposure limit, means that they're approved for 12 months, right? So the exposure limit, they get approved, it's good for 12 months. We don't have to pull credit, we don't have to get all the information every single time they want a loan. They can run these properties, whether it's a bridge, construction, or a fix and flip, off of that exposure limit as often as they want. As long as they got the liquidity to do it, we'll give them whatever loans that they want. So, bridge loan is gonna have almost identical guidelines to the fix and flip. The one difference is gonna be on the max leverage here in the middle. The max on a purchase is gonna be 80%, max on a refinance is gonna be 75%. And literally everything else is identical. I mean, terms and interests, everything. So there's not really a whole lot to go over on the bridge loan, except for the fact that any investment property, whether they own it or buying it, can go onto a bridge loan. We don't verify any rental income on that. It's just a straight loan for them to get quick money, you know, especially you have customers who have three or four rental properties. Maybe they own them free and clear. They lost their job, you know, with everything going on. They need some cash. We'll cash out all of those and give them whatever they qualify for. And they don't have to verify really anything. We're just going to give them the money, and they just have to be able to, show that they can afford the payment. But if those are all cash out, we use the cash out as liquidity verification. They don't really, like I said, they don't really need to come in with anything. And that goes on purchases too. They got, they want to just go buy, say, 3 or 4, like I said, Airbnbs or something, and they want to hold on to those, find some permanent financing, say 12 months down the road. They got the job back, they got everything, put back together. They just refinance those into permanent financing. They're set. I know there wasn't a lot on bridge loan, but any questions on the bridge loan?
No. I think that's good. I'm excited for the new construction part.
Okay, yeah, we are too. It just came out like 2-3 weeks ago. It's pretty aggressive. There's a huge demand for it in New Mexico from what I've been talking to people about, because just your inventory is just
Non-existent.
low, and all my builders in New Mexico are back up and running. They're just very excited that this is back as well. So what is our version of new construction loan? So it's going to be a short-term business purpose loan to finance ground-up construction of a residential small multifamily properties on a build-ready lot in urban locations. Ideal for residential urban infill builders doing a tear down and spec homes. These loans are not intended to finance owner-occupied borrowers or production builders in new subdivisions with greater than 10 homes. What that means in English is properties that need to be torn down, and they're going to build it up, build it back up from the ground up. That's what we can do. If your borrower wants to buy a lot and wants to put, build a home on it, that's what it's for. If you have a borrower who wants to buy a lot, hire a GC and then live in it, not what this is for. That'd be kind of forward mortgage side. They'd have a construction to perm. This is going to be for either investors who have GCs that they work with, build a property, turn around and sell it, or keep it as a rental, or builders who have the experience and want to get financing so they're not coming out of pocket, and they build it, and then they end up selling it, or they can even keep it. I have some builders who are going to build 2 or 3 at a time. Their first couple they're going to use as models. They build them, they refinance it onto a bridge, get it off the line, so they can go back and build more homes. So there's a lot of opportunity with the new construction. It's not for any kind of modular or mobile or manufactured. It's all got to be stick built.
Now with that, I saw that it said
Okay, so
up to.
this again.
I'm sorry. I saw that it said up to
Okay.
10
Oh,
houses.
okay.
What if we wanted to build 10 townhouses on a lot? Would that still work for that? If you're turning a single family into a
that'll
multifamily?
work.
Okay, cool.
Yeah, so what they're talking about is if you got a huge subdivision that's got 50 lots,
Yeah, okay.
and they want to put a home on each of those lots, and as of right now, that's not something that we can do.
Okay.
But if you have a subdivision that's got 10 lots, and they want to do 2 or 3 at a time and build those out, that's perfectly fine.
Okay.
And there might even be exceptions for that. I would imagine that would loosen up here in the next few months. Like I said, we just relaunched it, and they got to be a little conservative with what we can do. Because before we went down, we were doing 100, 150 home subdivisions.
Okay.
That was no problem. It's just with the relaunch, they just want to take some baby steps, get their feet wet, get some of these loans going, and then I guarantee it'll start opening up soon.
Yeah, okay.
So, but yeah, to answer your question, you have somebody wants to put 10 townhomes into a, you know, smaller subdivision, that is okay.
Perfect.
So again, everything on this is about the same, still falls under the same, exposure limit that if they would get approved for a bridge or a fix and flip. The only caveat to this, well, there's actually kind of an A and a B. So either the builder, or the investor has to have at least one new construction property that they have built and either sold or refinanced in the last 36 months. This one does require experience in new construction. Will allow up to 5 new construction transactions at one time. For example, if somebody somebody had 3 for experience in the last 3 years, we will lend up to 3 at any given time. And then, you know, after those are done, they'll probably meet that cap at 5 and be able to do 5 moving forward if they want. The other part to that is they have to build like properties. We'll go up to whatever. So somebody who maybe had 1 experience in the last 3 years and they build a single family will not be able to build a 2, 3, or 4 unit. But if we have somebody who built a 4 unit in the past 3 years, can do anything from a 1 to 4 unit. It's got to be like properties, up to the number of doors that they've done in the past. Does that make sense?
Yeah.
Okay. Minimum loan size on a construction is gonna be $100,000, and the max is $1 million. But if they're doing anywhere between 2 and 20 units, that's gonna be a minimum $100,000 as well. But our max will go up to $1.5 million. The LTC on these is gonna be 85%. It's a little bit lower than in the fix and flip, but it's still pretty aggressive, you know, compared to banks. Even a lot of hard money, it's gonna be pretty aggressive. We are going to still do the same financing, 100% of the construction costs. We will finance, let's just get the lot. We will finance 75% of the lot, and the remaining will go towards the 100% of the budget for the new construction. Okay, everything, like I said, everything else is the same type of properties, everything is pretty much the same. That's why this is kind of an easy sell for me. Once I get the information out on one of these, almost all of it is exactly the same with a few twists here and there. So makes it a little easier on me. The minimum interest on this one is gonna be 180 days versus 90, which should not typically be a problem. I mean, it's gonna take people usually 90 to 120 days to build, and then it's gotta go on the market, you know, they gotta get it approved, et cetera, et cetera. So that usually doesn't, that most likely won't come up either. Same with interest and eligible projects. We just went over that. The appraisal, interest reserves, everything is exactly the same. Any questions on the new construction?
Nope.
One thing I did want to touch on was the ineligible project scope. That one's a little bit different too. Again, build ready infill. You know, you have a house that needs to be torn down, you know, and it's in a neighborhood, that's fine. Mid-construction, now we can't do a purchase for mid-construction, but we can do a refinance for mid-construction. It's gotta be something that the borrower has. The reason why is, if it's mid-construction, they're buying it, we don't know the work that's been done, we don't know what we're getting into. So that's why we won't do the mid-construction. Other than that, everything else is pretty much on the table. All right. Keep it going. Single rental property loans. Okay, so single rental, very similar to what Forward Mortgage has. It's a long-term business purpose loan used for real estate investors, purchase, refinance, non-owner occupied residential investment properties. We use a DSCR. Our typical is gonna be 1.15 for a DSCR or greater. We will go down to 1.0 if it's a lower LTV. Again, we don't use any personal income, we don't use any tax returns, we don't use anything income related or job related. I'll be honest with you, I always tell people I'm kind of a plan B on this. I mean, if a borrower can get approved on a conventional forward mortgage, they may want to give that a shot. It's, might be some extra hoops they gotta jump through, but if they can get approved that way, they're usually gonna get a point to a point and a half better in rate, most likely. I'm gonna come in for those customers who have greater than 10 properties, like they're outside conventional. Those borrowers who can't qualify using their income, they write too much off. And for those borrowers who want to finance the property in entity, in their LLC. Okay, so I have some people come to me because it's just more like a streamlined loan. They know they can qualify on a forward. They just really don't want to go through it. The payment difference is $60 or whatever it ends up being, and it's just not worth it to them to have to go through that. So I always tell people when they have it, hey, can you qualify conventionals? It's something you want to do. My rate's going to start at 4 3/4, and go up to typically like 6%, just depending on the situation. So I definitely go over that with them. Because believe me, I don't want to get all the way to underwriting or docs and then be like, oh, I wish I would have, had a lower interest rate, or I would have gone through. Nobody wants to go through all of that. So it's we can do purchase, we can do rate and term, we can do cash out. Again, non-owner occupied only. None of the employment verification is needed. Loan size on this is going to be minimum of $75,000 with a max of $2 million. No experience required. The only requirement on this one is they have to have owned a home before. So we can't take somebody who's just coming out of college, wants to buy a rental property, has never owned a home. That's the only caveat. Everything else, first-time investors are fine. All of our loans are 30-year fixed for single rental and full amortization. So this is, again, when you're getting a 4 3/4 or 5 1/2, whatever it is, it's fully amortized, 30-year fixed. Our max LTV is going to be 80% on a purchase and rate and term, 75% on a cash out. And if a borrower owns a property but it's vacant, we're okay with that, but we're going to cap the LTV at 60%. Again, the debt service coverage ratio minimum, DSCR, is 1.15, and that's going to be for standard guidelines. If they're at 70% or less and have a 700 plus FICO, we will drop that to 1.0. The way that they get a debt service coverage ratio, for those of you who may not know, is basically the debt of the property divided by the rent. That number just has to come out to 1.15 or greater for full LTV. And if it comes in and say a 1.2, but they're less than 70%, and it's a 700 plus FICO, we're okay with that. Okay. Again, we'll lend to individuals and entities. The property types are going to be single family, 2 to 4 units, condos, non-warrantable condos with reduced leverage, townhomes, and PUDs. Okay. These new requirements to get new value, 180 days. We used to be at 90. I think that was kind of biting us on the backside, but that might be one thing that comes back. If they do it correctly, maybe a little lower LTV, something like that. But right now, for new value, it's going to be 180 days. One other difference with our loan versus a forward conventional loan is going to be the prepayment penalty. We do have a 3 and a 5 year prepay. Okay, let's get it on 5 year. It's going to be a 5% of the unpaid principal balance in year 1, or in year 2, 3 and 3, 2 and 1 for 1 and 5. And then the same thing on a 3 year, except for going to be at 3%, 2%, 1%. Okay. Minimum credit score on this is going to be 660. On this one, all guarantors, anybody who is going to be on the loan has to have a 660 or greater. We're still going to take the highest. But if you have 3 people, 2 of them are, above 660, one is a 638, we would have to make them a non-guarantor. You can still have them pretty much not on the loan, but they can still be part of it, meaning their entity, they can still be part of the entity, they don't have to remove them. They just questions on the single rental loan? Or anything. This is the end, so if you guys have any questions,
Yeah, I have my investor
a lot of info.
asking. Hold on. Let me pull it up.
You're cutting out. What was that?
Yeah, my investor, he asked about refi options for commercial real estate multifamily.
So are they talking about the 5 to 20 unit?
Yeah. Let's say 5 to 20.
Okay, so we do have that. That's gonna be a little bit different process. Basically on that, I do not, I mean, kind of the face of it, I don't do the pricing, I don't do, the breakdown of all the information. In something like that, what I would do is send over a rent roll. The rent roll gets completed, I send it to the scenario desk. That scenario desk puts the numbers together, reaches out to the borrower, and goes over options. It's a little bit different process, it's a lot different because I am not involved with the pricing, it's just to depth. But what I do is I get the paperwork together, and it's, like I said, it's just basically a rent roll. Put that up to them, and then they take care of it. Just a few things on that. We'll go up to an 80% on the multifamily. We do have a 30-year fixed option, and then we also have a 5, 7, and 10-year balloon option. But we do have it available. It can be multiple properties over multiple states. You can have a combination of purchase and refi all in the same transaction. That one requires a 620 credit score. And I'm trying to think of anything else I can throw at you on that one. Each building has to be 20 units or less. So you could have 5 15-unit properties, as long as they don't go over the 20 unit per building. We do have exceptions for that. You can mixed use. You can have, say, 2 12-unit properties and 3 single-family homes under the same portfolio.
Okay. Just get it started.
I was gonna say he can finish up.
Well, I gotta finish because I take out, so it all saves. Okay, perfect. Well, if he has any more questions, obviously now he has your number and your email address. So, if he wants to find out more, I'll just pass that along to him. Do you guys have any other questions on any of this?
Yeah, reach
No.
out anytime. We're happy to jump on calls with investors and go over information. It's pretty much what I do all day. So yeah, I mean, if you get a group together of investors and want to do one of these personalized for them,
Yeah.
let's say you have somebody and all they do is fix and flip. That's all they do. They don't want, rentals. They don't want. I'll customize it to what they want. We'll go over all the information, go over LTVs, and run any scenarios that they might want.
Perfect. I think that might be a good option to do. So we'll keep that in mind.
Sure. Okay.
Awesome.
Sounds good. Well, thank you, everybody.
Thank you.
Kind of reach out to me. Let me know, with a call. Let's I'll get you information on this and whatever you need. And then,